Hi everybody. In this series of video exercises, we're going to work a problem similar to one of your Chapter 17 homework problems. The purpose of this exercise is to carefully study the relationship among the elements of a pension plan, those elements being the projected benefit obligation, PBO, the plan assets, prior service cost captured in AOCI, net loss in this case. It could be also a net gain, but that is captured also in AOCI, the pension expense, and the net pension liability or asset. Of course, cash from the company is used to fund the plan assets. We'll use the pension worksheet shown in illustration 17-17 of your textbook as a guideline. So go to that page in the textbook and find this illustration. This is illustration 17-17 in your textbook. It is an important illustration, and I strongly suggest that you flag this page for reference during these videos, as well as for future reference. Each of these elements has been thoroughly discussed in prior Chapter 17 instructor video lectures. However, this illustration puts the pieces together in one place, emphasizes the relationship between the pieces, and will help you remember how the balance in each of the elements is calculated. The facts of the problem given are a partially completed pension spreadsheet showing the relationships among the elements that constitute Carney's Inc.'s defined benefit plan follows. That's this. 6 years earlier, Carney revised its pension formula and recalculated benefits earned by employees in prior years using the more generous formula. And that's what created the prior service cost. The prior service cost created by the recalculation is being amortized at a rate of $5 million per year. At the end of 20X1, the pension formula was amended again, creating an additional service cost of $40 million during the year 20X1. The expected rate of return on assets and the actuary's discount rate were 10%, and the average remaining service life of the active employee group is 10 years. Given those facts, we're going to fill in the blank pieces, and the blank pieces are those boxes in yellow. Notice that credits are indicated in brackets. The PBO is a liability, so its balance should be a credit balance, and that's why it's in brackets, whereas plan assets are an asset, and they have a normal debit balance, so you would expect their balance to be reported as a debit, and that's why there's no brackets around the $680 million. So, credits are in brackets, debits are indicated by positive numbers or numbers that are not in brackets. Also, each of these numbers represents millions, so this is not $830 PBO, it's an $830 million PBO. Now that we have the facts of all this straight, let's see what we can do about filling in the numbers for the PBO. We're going to get to a point where we can't calculate any more numbers until we have other calculations done. But let's start with the PBO and see where we end up. Once again, it's important to remember that the PBO represents a liability to the company. So increases to the PBO should be shown as credits with brackets around the number, and decreases to the PBO should be shown as a debit without brackets around the number. The PBO is increased by the current year service cost. This is an easy number to find in this problem because service costs are also a component of pension expense, And the worksheet shows a $74 million debit to pension expense. The credit then belongs in the PBO as an increase to the PBO. So we write the 74 as a credit because it's going to increase the PBO. Interest costs, current year interest costs, also increase the PBO balance and also increase the pension expense balance. We don't have a handy little clue here, but we do know some things. We know the beginning balance of the plan assets were, the beginning balance of the PBO was $830 million. And we also know that the actuary's discount rate is 10%. So the current year interest cost should be the $830 million times 10%. That will increase the PBO with a credit, and it will also increase the pension expense with a debit. Go ahead and do those calculations. Fill in your credit here and your debit here. Then start the video again to check your work. So the current year interest cost is $83 million, calculated as $830 million times the actuary's discount rate of 10% equals $83 million. That increases the PBO, so we have to credit the liability, PBO, and we need to debit the expense, pension expense, $83 million. Now let's see what we can do with this loss on PBO. As discussed in instructor video lectures, a gain or a loss on the PBO is calculated when a change is made to the estimate used in calculating the PBO. We are not given any verbiage in this problem to explain the loss on PBO. However, we are given the $13 million loss number in the last column. As shown in illustration 17-8 of your textbook, and as described on the textbook page prior to that illustration, a loss generated by a change in an estimate will increase the PBO liability. Accordingly, we should show a $13 million credit to the PBO column and add a $13 million debit to the net loss AOCI column. Go ahead and do that, and then start the video again to check your work. The loss on PBO will increase the PBO balance with a credit, and we are accumulating the plan's net gains or net losses in AOCI, and we need to increase the prior balance by $13 million this year. Now let's look at the 20X1 new prior service cost. In the details to the problem, it said that the plan had been amended in 20X1 and the pension formula was changed through that plan amendment, and it was retroactive to prior years. It created an additional service cost of $40 million. So we need to increase the PBO balance by $40 million, and we also need to increase the prior service costs that are captured in AOCI by $40 million. Go ahead and record those numbers, then start the video again to check your work. We should put a $40 million credit in the PBO column and a $40 million debit in the prior service cost AOCI column. Retiree benefits. At this point, there is simply no information available to calculate the retiree benefits. We do know that payment of those benefits will reduce the projected benefit obligation. So this is going to be a debit, but we just don't have enough information to calculate that number at this point. So let's move on to the plan assets column and see what we can do with this column. The plan assets are increased every year by the actual return on plan assets. As shown in the worksheet, the expected return on plan assets was 10%. It says that the expected rate of return on plan assets was 10%. So the expected return on plan assets is the beginning balance of $680 million times 10%, and that will be an increase to the plan assets. It will also decrease the pension expense for the year. Think of it this way. If the company owes the plan a certain amount of money, and part of that money is funded by investing the assets, then the expense to the company is reduced by the amount of plan return on plan assets. So calculate the expected return on plan assets and record it in the plan asset and pension expense columns. Then start the video again to check your work. So the expected return on plan assets is $68 million. That's the beginning balance times the expected rate of return of 10%. We need to put a debit in the plan assets column and put a credit in the pension expense column. So the plan assets have to be increased by the actual return on plan assets. As shown in the worksheet, the expected return was 10% or $68 million. However, as shown on the worksheet, the assets actually returned $7 million less than expected, generating a $7 million loss on the plan assets. The $7 million credit to plan assets was already recorded in this column. We need to show that loss as an increase to the net loss captured in AOCI. So credit in the plan assets column of $7 million and a debit of $7 million in the net loss AOCI column. So we have a couple more spots to go in the plan asset column. Let's look at the cash funding. The plan assets are increased when the company puts funds into the plan. The worksheet shows that the company funded the plan with $84 million. It shows that in the very last column. Money coming into the plan assets should increase the assets with a debit. And money is used from the cash of the company. The company literally writes a check to the pension plan, gives that check to the trustee who deposits it into the plan, and then the funds become available as part of the plan assets. So we have an increase to the plan assets and a decrease to the company's cash for $84 million. Please write those debits and credits in the proper column. Then start the video again to check your work. So we have an $84 million debit to the plan assets column and an $84 million credit to the company's cash column. Now we're in a spot where we can back into retiree benefits. We know the beginning balance and all the changes except the retiree benefits paid, and we know what the ending balance ought to be. So 680 plus 68 minus 7 plus 84 plus what equals 775. solve for the plan assets. That will decrease the plan assets because we're spending the money out of the plan assets to pay the retirees. It will also decrease the pension projected benefit obligation. Go ahead and do the calculation and then write your debits and credits in these two columns. Start the video again to check your work. So we credit the plan asset column by $50 million. Then if you add that up, it will equal $775 million plan asset balance at the end of the year. Now we have a reduction, a debit to the PBO, and if we add that up, we have a $990 million credit balance in the PBO at the end of the year. Well, that's all I can fit on this video. In the next video, we'll see if we can finish up all the rest of the yellow boxes. See you next time.